Hey guys, welcome back to the last session of Chapter 3. Now remember how the modern portfolio theory leads the investment goals. It says that we need to find an efficient investment choice. What is efficient? Now, it means that whether it's a single asset or a portfolio, it needs to offer the maximum level of return for a given level of risk, or it needs to have the minimum level of risk when offering a given level of return. So that's how we define efficiency. Let's just imagine a case where we have gathered all the efficient investment choice available on the market. We form them together to draw a beautiful curvy line. Now, that line, which gathers all the efficient investment choice available on the capital market, is being referred as efficient frontier. Now, spoiler alert, it looks like that. Now, let's just ask a question. In this efficient frontier, which is more likely to be the choice of investment? Individual asset or portfolios? Well, it should be portfolios because we know the presence of covariance, and we know that a negative covariance, especially a -1 correlation coefficient, can allow for the presence of a risk-free portfolio yet filled by risky assets. So that's why we say portfolio is more likely to be efficient compared to single asset. That's the power of covariance. Now, how can we draw this efficient frontier? Now, say we set a certain risk level. Let's just pretend it's vertical, all right? It's not. Well, let's pretend it is. Okay, say this is a vertical line which gives a risk point at, let's say, R1. Now, we can see many cross points here, here, here. Let's just make these three as an example. Here, here, here. So these are the portfolio possibility line. So these are the possible risk and return combination for portfolios that are filled with different weights of assets. Now, when we draw a vertical line, we can see the cross point from high to low. Now, the highest cross point here is the highest possible rate of return at this given level of risk. So, this point we can say is efficient at this risk level. So that's one way to determine an efficient investment when we set the risk level at here. Now, let's draw a parallel line. Okay, that looks better. Let's say that's a parallel line, which gives a 15% rate of return. So, along this vertical axis, we have cross point from here to here. And here are two possible portfolios that actually exist in the reality, offers 15% of return. And we can see that this cross point here compared to this point offers smaller risk or contains smaller risk compared to this investment choice. So that means this portfolio is more likely to be an efficient portfolio compared to the investment choice here. So at least we can say at the return level of 15%, this is our efficient investment choice. Now, that's how we determine an efficient investment when we set the return level at 15%. So that's two ways we can determine where an efficient investment is at. Now, what we need to do is we connect all these efficient investment choices together. We are gonna look at a line just like that. It is upward. It is upward. It shows the efficient frontier. Every dot on this line represents a choice of efficient investments. They are corresponding to different risk level, of course. And then, like we just talked about, the investment choice on this line are more likely to be portfolios rather than single investment. However, there are two exceptions. The starting point here and the ending point here. These two are likely to be two individual assets. This one refers to the asset that contains the lowest level of risk. See, it's still risky because it's not risk zero yet, right? So it's still risky. The lowest level of risk that is being referred to a single asset. And that is the single asset offers the highest level of return. And we can see that the slope of this efficient frontier becomes smaller gradually. So that shows a decreasing marginal effect in terms of risk award. When we are at a higher risk level, when we take on the next risk unit, the return we get in compensation of holding on additional risk is actually getting smaller and smaller. So that is the marginal effect right here. And also, noticing that this is a curvy line, not a straight line. This is because the efficient investment choice on the market are not perfectly correlated with each other. A larger correlation would make the efficient frontier more flat, while a smaller correlation coefficient would lead this efficient frontier become more curved. Now, let's see the portfolio A, B, C here. Now, portfolio C is not efficient because it is inside of the efficient frontier. Now, compared to portfolio B, they have the same level of risk. However, portfolio C offers a much lower return compared to portfolio B. Now, for portfolio A, it offers the same level of return compared to portfolio C. However, portfolio A have a much smaller risk level compared to portfolio C. So that's why the dot inside of the efficient frontier is not efficient. Now, is there any dot beyond the efficient frontier? No, not at this stage. Because if there is, then there will be a shift in the position of the efficient frontier. It is the borderline. It is the edge of the efficient portfolio possibility line. So that's the edge here. There's no point beyond. Otherwise, we shift the efficient frontier. Now, how can we determine if one investor should set on a certain efficient investment on the efficient frontier? That's when we introduce utility line. Now, if you have take any econ class, you know that utility line actually shows the willing trade-off between risk and return. So, let's see the efficient frontier. It is also being put in the dimension of standard deviation and return. So that's our x, that's our y. So that means we can put the utility line and efficient frontier into the same dimension. Now, we are looking at two sets of utility line. One from investor A, one from investor B. Why? Why we can say they are the utility lines from two different investors? Well, because the slope of their utility line is different. This one have a larger slope, this one have a smaller slope. And for one given investor, its utility line are parallel to each other. So there is no intercept. And also, for a given utility line, any dot on this line represents the same level of utility. And a higher positioned utility line offers higher level of utility. So that's how utility line works. It shows people's willingly trade-off between risk and return. So what we need to do is we find the tangency point. The tangency point between the efficient portfolio possibility line, that is the efficient frontier, and the utility line. So this magical point here shows the connection between a actually existed efficient investment choice and one's investment willingness. So this position offers the investor the right amount of return and the right amount of risk he or she willing to take. So that's how we define this tangency point here. Now pay attention. When we have different investors, A and B, and they have different tangency point because their risk tolerance level is different. Now, we see that this utility line of investor A actually have a larger slope compared to investor B. So what does that tell us? It means that for one additional increase in risk, investor A asks for a much larger return in compensation compared to investor B. So that means investor A is actually more risk adverse compared to investor B. So A is more sensitive to risk. So that is why their final position landing on efficient frontier is different. The optimal investment choice for A is X, and the optimal investment choice for B is Y. And the two is different because X and Y, they are both efficient, right? The difference is that X is a much less risky investment choice compared to investment Y. And that is corresponding to their risk tolerance level. Because we just said, given the slope of the utility line of investor A, we know this investor is much more risk adverse compared to investor B. So that's why their final optimal portfolio also different. A landed on a less risky, efficient portfolio compared to investor B. Now, that is how we put efficient frontier into reality. So that is how we determine which investor should choose when we have multiple choice in the efficient portfolio possibility line. We find the tangency point between the utility line and the efficient frontier. And that's it. And also, remember, we can use utility line to show one's risk tolerance level. Let's make a quick summary for Chapter 3. The first one, how can we say an investment is efficient? We look at their risk and return. That's their expected return and their standard deviation. We want the highest level of return possible for a given level of risk. We also want the minimum level of risk for a given level of return. And also, we learn about how to capture the correlations between individual asset that is being put into one portfolio. And we know that if they have an active, even a -1 correlation coefficient, that can give us a better risk reduction in the portfolio building process. We can even build a portfolio that contains zero risk, yet still offers a much higher return compared to a risk-free rate. Now, we also learned the efficient frontier, which gathers all the efficient investment choice available on the capital market. And what we want to put them in use is we find the utility curve and we see if there is a tangency point. That tangency point reveals one's optimal portfolio that is corresponding to one's risk tolerance level and also fits their investment need in terms of the level of return. All right, that concludes today's lecture. Thank you for joining me. I will see you next time. Bye-bye.